The fact that we actually recovered, we actually made like 2 or 3 times on whatever investment amount we did in the beginning. That for me was a very pivotal moment that I saw that just because we didn't give up, the line between success and failure is so thin. So the impact of being in a VC space is that you really can influence like the technology founders that you back.
Welcome to Analyse Asia, the premier podcast dedicated to dissecting the pulse of business, technology, and media in Asia. I'm Lyon, and we're diving into how True Global Ventures have just taken the major regulatory leap with getting their capital markets service license from the Monetary Authority of Singapore. With me today is Beatrice Lion, Chief Executive Officer of True Global Ventures, to explore what this means for the future of investing, whether it's tokenized assets, whether it's AI, blockchain and stablecoins in crypto treasuries, and also continuation funds. But first of all, Beatrice, welcome to the show.
Thank you, Bernard, and I'm glad to be here today. And thank you for having me on the show.
Yes, you're probably one of the youngest chief executive officer to run a fund. So I want to first start off is, how do you begin your career journey and what led you to the world of venture capital?
Thanks for asking that. So I actually started in 2017. I met this initiator of True Global Ventures, Dusan Stojanovic. And, I really believe in his vision. And I thought that the venture capital industry in Singapore was just about to start to get developing and, getting hot. And most of my peers out of school, so I started this really out of school. Most of my peers out of school, as you can imagine, I did like a finance and economics degree. So they all went to banking, consulting, and the VC space was just kind of growing. And I thought I want to be in the frontier of technology. I want to be the one that brings a new tech to be an early adopter as opposed to be like a mass adopter or a laggard. I want to bring that to my friends, and I want to be the one that's saying that, I back this amazing company and new technology. So I'm a little bit of like a technophile, if you call it. I really like exploring new technology. So that's why I jumped into the VC world. And so this moment actually with the license is a bit of a full circle moment for me, because when we started True Global Ventures with really more investment vehicles that were investing into companies that were basically in AI and blockchain. So the thesis has always been the same. However, what changed was that we decided at some point in 2018 that Dusan came up and say, why don't we start building it with LPs, so pure financial investors. So then I was like, okay, this sounds like an amazing journey. And, it's the first time that I got an opportunity like that. So I was like, forget about all the opportunities, the banks and consulting companies. I can't let this ship sail. So that's what I did. And end of 2018, we got the Venture Capital Fund Manager license. So it's definitely a much lighter license, but it was suited and fitted for our size at that point in time, because we were doing like a first-time fund, first-time kind of external money fund. And so this point with the Capital Market Service license is a full circle for me, because I was the one who was driving the entire process, getting the Venture Capital Fund Manager license in the first place, end of 2018. And what we have right now is pretty exciting, I would say.
We're going to get there as well. So
yes.
I'm quite curious, right, that how do you eventually become the chief executive officer? I guess this is a pretty big initiative. I think later when we talk about the capital markets license, I think that you people will understand the magnitude of what does it mean. But maybe for you, starting from school, going straight into venture capital, because usually most venture capitalists in our Asia region tend to be either they are formal investment bankers or business operators. My wife and I had a philosophy. We told our kids, none of you are going to be VCs unless you have worked before, and we will never support any fund. But that's our own preference. I think everybody's career journey is different. So how's your career journey like?
Yeah, so when I started with supporting a lot of our portfolio companies. So it's more like business development. Obviously, I didn't, jump into the deep end of the pool. We started with focusing on adding value to our portfolio companies. I really like doing that because it's not just working with one portfolio. You have different technologies, different contexts. It always gets exciting because there isn't really a work scope. Every day was like a different experience. It was very trying. It was like, I always aligned my job in my head to, being like a fireman. Basically, you're extinguishing fires all the time, supporting our portfolio companies and, trying to help them with solving their problems, helping them with strategic thinking. So that's how I started as a business development for our portfolio and managing that and helping them to grow. And I was lucky enough to have, the opportunity to be involved in some of the turnarounds. And quite honestly, that was a very exciting time for us as well, because a lot of VCs are proud of their, unicorns or whatever that word really means right now. But they're very proud of like their successes. Of course, we are very proud of our successes as well. But I think we are equally or as proud as our kind of turnarounds, where we managed to derive something from the value of the company that we invested into, even when other VCs would have given up and say, this is a write-off. And one of the ones that I was very involved in is actually this, I would say it's like a platform for developers to solve bugs. Anyone can put like a bounty to solve a bug on this development platform. And we actually sold it twice before we exited it. So the first part was like when we sold, they were basically, management decided that, this is not growing like super steep. This is growing like super slow. And we want to leave. So imagine a company without management. Any other VC would have been like, okay, this is a write-off because the team that I back is not even there anymore. But obviously the Silicon Valley founders, they were comparing with their peers and they're like, all my peers' companies are growing like that. This is so steady. Maybe it was too early at that point in time. So it was not exciting for them. And what happened was that we actually sold it to another company that was in the gig economy as well. They were seeing this opportunity and they were saying that, hey, I can actually just envelope that in and expand in the development space. So they did that and we did sell it, but we stayed on a cap table. And, some people might say, like, why are you staying on a cap table? Because we found the buyer. So we have to show the conviction that we still believe in this. And quite honestly, it's an amazing idea because even without management, the company could sustain, because if there's a bug on the platform, they just put it up on itself and then the payout goes. It's really the kind of true form of where decentralization really started, because you can have no management, but the company is still running. And then fast forward 2 years, same story repeated. The acquirers didn't take care much of the company. They just focused on their main business and they kind of moved on. And so they said, like, can you help me get rid of this asset again? So, deja vu, but we repeated a little story. This was roughly in February 2020. I remember we were in Paris. We were kind of sharing a lot about portfolio companies. We do a lot of these events as well. And during the dinner, Dushan actually mentioned, we have one of this portfolio company. They have an exciting client, IBM, who really buys it. So actually they have one of the strongest clients, which is IBM. Is anybody interested? And, then that's where we actually found the second buyer. And it's a Euronext listed company. And that was when we actually got our exit, because then we got public shares as a swap on that. And obviously we got a lockup. When we did the deal, the company was valued at about 30 euro cents. And then when we exited, because of the lockup in the period, we did everything between 250 and 3. So that's a pretty good multiple. Sure, we took a longer time. There was a bit of roundabout. But the fact that we actually recovered, we actually made like 2 or 3 times on whatever investment amount we did in the beginning. That for me was a very pivotal moment that I saw that just because we didn't give up, the line between success and failure is so thin. So the impact of being in a VC space is that you really can influence like the technology founders that you back.
Yeah. But then you still haven't tell me, like, most VC firms, right? They only have partners, and usually they run more like, I think, like a law firm or consulting firm.
Exactly.
And very rarely, maybe I will think of Andreessen Horowitz, but it's quite unofficial. They say that they have a CEO. So I guess what is the plan in a way that you need to have a formalized role of a chief executive officer now for TGV?
Yeah, so I got a bit carried away with, why I was so obsessed
No,
with
it's
this.
exciting talking about the kind of firefighting journeys, right? Everybody likes a turnaround story. So I also like a turnaround story.
Exactly. A successful one as well.
Yeah.
And, basically the role of CEO, it's not that I make all the investment committee decision. No, I still have like an investment committee for each fund. We have different investment committees set up. So I'm just one of them. But the good part of that turnaround story is that, I got some carry from that. That was how I invested into my own fund as well. So I wanted to put a very significant portion of my wealth into my funds because I wanted to be seen as a partner, not just an employee. So that's how it started. So I have a seat at the investment committee table for our regulated funds, 4, 5, and 6. And basically with that, the CEO role is really being the glue amongst our partners. So operationally, we need to make sure that, we are fulfilling the governance, the compliance part of it. We can run and function smoothly. It's not just disparate partners doing their own jobs, etc. Which is like like, for example, a law firm partnership or a consulting partnership that you talked about. It's a series of partners working together.
Yeah.
And I always see myself as being the glue in that, a little bit more on the kind of operational excellence and the relationship part of that. And sure, it was very intimidating for me to step up in this role because basically I was very empowered with our initiator of the fund, Dushan, who said that you know the partners well, you can be the glue, and you have operational excellency, which is more an execution piece. So, why don't we just put you up? At that point in time, I was very intimidated. I was 28 when so it was about just 2 years ago around there that I really became CEO because, that was something that was a big responsibility. I'm very glad my partners trusted me. They didn't diminish whatever I said just because I was younger or I was female or anything. None of them did that. So we're a very flat organization. So I got the opportunity to do that because my partners also respected what I said as an equal. So I think that was very important for me. I don't really see myself day to day as a CEO as much as, operationalizing and making sure, our partners are in the loop of being basically one platform, one fund, one investment team, as opposed to, just running their own shop and running their own investments only. So I would say that's how my role kind of pivoted. And it was useful for me because I was kind of already being the glue amongst the partners when I was helping with the portfolio investments. I was helping partners across, different partners across their different investments. So that was kind of how I landed on this CEO journey.
Yeah, I think it's interesting in that sense that something like maybe getting the capital markets services licenses was also part of the kind of initiative where you need a central coordinator among different partners like yourself to drive it on it. But before we get to the main subject of the day, I just want to ask one thing. If you were to reflecting on your journey, what are the most pivotal lessons that you can share with my audience?
I think it's just that, to be honest with you, I was very intimidated if, MAS would even accept me as a CEO because, as a regulated fund manager, every position in executive officer would have to be approved by MAS. And I think one of the kind of important moments that kind of encouraged me a lot is that, sure, MAS asked questions about like whether I had enough experience to be a CEO, how many people I've ran before. It was a very, very detailed question. It was like a whole list of 16 questions. And the fact that they gave me a chance, they didn't reject the application immediately, made me feel like there was that opportunity and they didn't diminish, just because of my age, just because of like experience. Obviously, if I was an ex-investment banker, been in the industry for 20 years, so much more easier for them to approve. But the fact that they saw that diversity being important for a company, and that's kind of the thesis of us because we always believe in diversity. We have people in different generational, like in the 50 plus, the 40 plus, and then myself. And, we have that kind of handover of the different generations as well. So I think that was kind of very important for me to recognize that like that was an opportunity and I should keep striving for it. So when I saw that, I was like, okay, you know what, let's really go for this. Yeah, they didn't reject us outright. They didn't kind of like, kind of wave us off in the application.
I think to be fair, right, I think MAS or Singapore regulators tend to be quite enlightened when it comes to matter of this. So I'm going to get to the main subject of the day. I think to start, even though your colleague Kelly has been previously on the show,
yes.
Can you give me a comprehensive overview of True Global Ventures and also maybe reiterate their investment thesis in the global markets?
Sure. So we have now active funds. We have Fund 4, 5, and 6. And like I said, the nomenclature of 4, 5, and 6 is because we used to have investment vehicles before, but they were not regulated. So we actually had to change their name and, they're now Innovation Founders Capital, separate it from our portfolio. So we have 4, 5, 6. 4, it's an early stage fund. It's a $113 million fund. We are in the vintage of 2021, but we already started warehousing the deals in 2019. It was a first-time fund, so it took a while to raise that. But we are already now ended the investment period October last year. So we are basically focused on harvesting in that fund now. And then we have on the back of the early success, because we had fantastic returns that puts us in the top 3 percentile of VCs in that vintage in terms of DPI, distribution versus paid in, and TVPI, total value versus paid in. We actually, on the back of that, raised our Fund 5, which is a growth stage fund. So an opportunity fund. And the goal of that was to invest into follow-on opportunities from the base fund, which is our fund 4, or new opportunities in the later stage. So how we define that is Series B, but really 10 million of annual recurring revenues and above, or 5 million with 50 to 100% year-on-year growth traction. So that was a $166 million fund. We are still in the deployment phase, so we still have a year for deployment. We are roughly about 50 million in reserves for follow-on deals in some of the deals that we have done as well. And then we just did also the initial closing of Fund 6. So Fund 6 is set up to be the next early stage fund as a successor from Fund 4, because now we have completed the investment period for Fund 4. So Fund 6 would be basically early stage targeted 100 million. You would notice that the size that we focus a lot around is 100, 200 million, because we think that we can deliver performance there. We're not here to optimize our management fees, so we don't see that even if it's our third fund, we need to raise a much larger fund. We're here to optimize on performance because we do invest a lot of our own money as well in it. In terms of our investment thesis, so we invest across artificial intelligence applications and blockchain applications. In our Fund 4, it was mostly on the blockchain side, I would say, in terms of portfolio companies that landed up. And in Fund 5 was more on AI. In Fund 6, the focus will be a lot in AI as well. But we have also been cultivating the expertise around the intersection of AI and blockchain. So that's the exciting part about what we are seeing as a differentiator, given that we have been investing into two technologies. Geographically, we invest globally. So we're not investing, in what we call like a church view, or, regionally, we do focus on North America, Europe, and Asia, specifically in 8 cities. So Bay Area, New York in the US, London, Stockholm, Paris in Europe, Dubai in the Middle East, and Singapore and Hong Kong in Asia. So these are where we have deeper networks. So we feel that we have a proprietary deal flow here, as well as where some of our LPs are coming from. But the focus there is that we are able to identify how some of these companies can also work well in other jurisdiction, and that's where we see also as a differentiator from a global investment thesis point of view.
So I remember that Kelly once mentioned that you also fund only serial entrepreneurs, meaning
That's
that
true.
the entrepreneurs that you fund cannot be a first-time entrepreneur. This is their second or third gig. Does that part of the thesis still stay there?
Yes, it still stays there. So we do like to prefer to fund tested entrepreneurs. I think we have made like one exception, something like that, but we have always stuck to that thesis because if they have sold a company before, they don't make the same mistakes. So capital efficiency is increased generally. And at the same time, you don't have a situation of like first-time founders' mistakes, for example, leaving like dead equity because you try to split out the shares too equally amongst many co-founders. You also learn to bootstrap your company better. So like how do you turn around, like, maybe you need to make harsh cost cut, stay lean and, cut a lot of excess when you're running out of cash, for example. So there are some of this that we have identified that first-time founders technically take more time to adapt to, which tested entrepreneurs, even if they're selling a company that is not in the same industry or in the same space, they have done it before because they've sold a company before. And they also start to have an embryo of, being able to pitch, knowing how to get investors, maybe not the same Rolodex that we have, but, they start building their own. So I think that's a little bit how we see as a differentiator. We have made like an exception, but it's quite rare.
I think because first-time entrepreneurs always look for product market fit. I think second-time entrepreneurs, even for myself now, I'm thinking of it is mainly distribution. The product market fit is not so that important until you figure out exactly what the customer wants. Yeah, but I want to talk about the big milestone. I think we have already earlier in the conversation talked about the CMS license from MAS Singapore. Maybe tell me, what does the license enable you to do now that wasn't possible with the venture capital FM framework that is done by MAS itself?
Yeah, so the VCFM framework had this constraint, which is very limiting. It was 20% maximum of the fund that we have can be invested into secondaries or companies that are older than 10 years. So because of that, and at an early stage, maybe when you're investing early stage, it's not such big a constraint, but it actually is still, because when we look at companies that, especially during macro cycles, and some companies, they don't raise when, obviously the macro is down, they don't want to get a down round, for example, or they have very rich treasury, and they don't need to raise the follow-on round. So we are typically investors that follow on in our investments. So we're not the one that, spray and pray, which is a different strategy, but we always have a good reserve for follow-on. So we invest in companies 2 times, up to even 5 times, even sometimes across different funds. So that is something that was a very stifling area where there was a lot of pressure, like what happens if we come towards the later part of investment period and we're coming to the end of investment period, but the company we invested into still hasn't raised a round. So typically what we'll do is that we'll expand our exposure to getting more secondary so that when they raise a round after the investment period of our fund, that we can still, retain a sizable percentage stake in a company. So that was one piece. And then when we come to our Fund 5, when we were investing in companies that have 10 million ARR or 5 million and above, these companies took time to find their product market fit. And basically, with artificial intelligence, a lot of people were very apprehensive to actually use it until the phenomena of OpenAI and ChatGPT. And so because they had to do a lot of pivots, these companies were older. So incorporation-wise, it could be more than 10 years, but the business really started picking up maybe in the last 2-3 years, which is a very exciting growth story for us still, because they took time and whatever before that was maybe a write-off.
Or maybe one of the other kind of companies we are thinking about is companies that stay private super long, like Stripe.
Yes.
That's also part of the calculus.
That could also be, exactly. And opportunistically, that might be something interesting for us as well. So because of that constraint of just only 20%, which, maybe that ruling, if I were to be a bit more aggressive, can be a little bit obsolete in the scenario we're dealing with today, then, that was something that pushed us to say that let's go for a bigger license. So the LFMC Licensed Fund Manager Company license under the Capital Market Service license is actually quite broad. So it allows you to do many different asset classes. But the real trigger was because of this 80-20% rule. That's why we ventured into applying for that.
Interesting. And I think a lot of people don't realize how difficult it is to get a CMS license in Singapore. I think usually these are something that is owned by maybe private banks, maybe some very established investment banks. Maybe why is this regulatory upgrade significant? I think for two things, right? You talk about the ownership piece where you need to go above the 20%. How about, say, your LPs, your portfolio companies, and maybe even think about True Global's ventures positioning, say, in Singapore and globally?
Yes, definitely that gives us a huge boost. So you're right. It's very rare for a VC to actually apply for such a big license because of the regulatory burden and cost that comes with it. So mostly it's a private equity or hedge fund that would apply for that. That's for the different asset class. But increasingly we've seen, for example, and recent, General Catalyst, most recently Lightspeed, Sequoia has it as well.
Yes.
They have applied for the US RIA, Registered Investment Advisors, which allows them to also expand their scope beyond venture investing.
That's right.
So we're not the first globally.
So you're saying that
that
getting the CMS license is quite similar to taking, say, the US RIA license that's actually held, I think, by Sequoia and Andreessen Horowitz. And I think they are calculus slightly different. They want an evergreen fund situation.
Yes.
So are you all thinking in the same
framework?
Well,
for us, there are 4 main areas that we're looking at that we actually want to expand into. So the very immediate one is a combination of secondaries and continuation funds. Right. So as we come later and later, there are opportunities that we've already identified. This is a winner. They're going to get to IPO. But after the follow-on round of Fund 5, we don't really have a fund that could actually do that. And it would be too late back to the 10-year rule in the VCFM license. So immediately now, that's where we actually see that that's one of the first theses that we can already play into, coming in where we can invest into companies at a later stage, where we come in primaries, but also take up the secondaries because we've invested in a company before. So we do know the cap table. We do know the opportunity to help clean up the cap table. And quite honestly, the entrepreneurs appreciate that as well because when they're mature, they do want to get rid of or kind of clean up the cap table from angel investors who backed them in the earliest round, for example. So that's one of the first key thesis that we can see immediately implementable. In fact, we're actually doing quite a lot of secondaries transactions right now from our existing portfolio companies to acquire a larger percentage stake into them. And then the second piece that we see is, let's talk about the elephant in the room in crypto funds. Given that we invest in AI and blockchain, a lot of times we don't put, before we got this license, we don't put any cash into crypto. So a lot of times people ask, are you leaving money on the table because you can't invest in tokens, you only invest into equity.
That's right.
And now that is lifted, we can invest in tokens should we want to. I don't think, today we're going to say that we're going to buy up whatever amount of tokens in the industry. No, we're still going to look at it through an equity point of view, but then we have the option always to buy. If our blockchain companies issue tokens, we always have the option to buy. We can have the option to hold. We can choose when to sell. Previously, anytime tokens hit our balance sheet, we would kind of liquidate them just to be safe. So I think these two, I would say, is the immediate impact for us, especially the second one on Fund 6, given that we still do invest in AI and blockchain. And then further on down the line, how we see it is that we definitely want to go into also fund of funds, but that will be the medium to long term. And we do see that, with it's kind of it's almost like an angel investor placing a bet into multiple startups. It's a thesis that we were looking at, that as a fund manager, you're placing bets onto emerging fund managers and taking a bet on each of them and then helping them to seek through the same struggles that we did when we were a growing fund, a first-time fund.
Maybe also to help you to seed the earlier stages, right? Because now you're focusing on the AB, even upstream of the rounds, which I think specifically Asia is missing the AB rounds now. But maybe for established markets in the US, we are talking about growth investing.
Yeah, so I would say we still look at late seed rounds, but we don't do anything pre-revenue. So, a lot of this deal flow could come in also from the fund of funds. Should we set it up that the deal flow comes in from there? We typically invest when companies have 1 million ARR in the early stage as well, or coming to that. And the reason why is because along the way, we found out that our greatest strength is that we can help to replicate, or kind of, if you have a client profile, you have a product market fit, we can replicate it with our network. But before that, say, if it's a company targeting financial institutions, banks, and insurance companies, and if we make 70 introductions to you, and then next month you decide to change your model, then it kind of goes two ways. But if you already identify that this is a pain point you're solving, then it really helps that we can give you the value add with the kind of network that we have. So that's why we kind of came in and said that previously when we did investment vehicles, we did even pre-seed companies, like pre-revenue companies, but now we do it post-revenue companies. So that was a little bit of a change thesis. But to your point, yes, fund of funds could be something that gets us deal flow. And then last but not least, we're also looking a lot at the opportunity for crossover funds. And that is also a medium to long-term thesis for us, because as you come later stage, you want to support a company that kind of gets into the IPO part. And typically, sometimes after the lockup period, the price of the shares might dip. And people might be not as understanding of a company. For example, we have listed companies on New York Stock Exchange before, Forge Global, which was listed in March 2022. They were trading since then. And we know that the business is a cyclical business. So when the IPO markets are open, they have a lot of trades. So they're basically a secondaries trading market platform, very transparent for people who want to buy and sell trade secondaries. And because it's such a cyclical business, when the IPO markets was closed, it was very depressed. It was basically valued at like cash position. And so when we saw this opportunity, we would be, personally, there's a possibility we could even buy it because we're not conflicting with any of our investment thesis. But moreover, thinking about that, we could actually invest into that as a fund and share the commercial economics with our LPs as well, because we saw that opportunity knowing the business so well that maybe the plain public equity investor analysts did not have that background of this company. If you just look pure numbers today, they would just see that maybe it's not that interesting to look at, for example. So I think that's kind of how we look at it. So immediate term, continuation funds, secondaries, and crypto funds. And then in the medium to long term, we're looking at basically the opportunity for fund of funds and also in the public equity or crossover shares.
I want to talk about secondaries because I think the vintage in 2021 and 2022 are all overblown. So now there's a lot of down rounds or maybe bridging rounds going across. I know of a couple of secondaries who are actually advised to come to talk to the LPs in this region. How do you plan to approach secondaries in your portfolio in this situation now? And why is it that it's going to be a game changer? Because maybe this is the best time to buy distressed assets and go up, but maybe that's...
Yes, the secondary opportunity is something to navigate as well, because in the stack of a private company, typically you have liquidation preference. So sometimes the waterfall is such that if the company raises or lists at the next round being lower than last price round, the preference shareholders actually get the bulk of it. So you have to be very careful what kind of class of shares you're actually buying. So that waterfall is important for us. So if the company with a lot of conviction that the valuation is fairly priced, next round is going to be an up round, or pre-IPO round is going to be an up round, then that's definitely an opportunity that we see that if we get like a lower class share, then maybe we still get a good preference. And it's actually discounted in that same way as well. So the lower the preference, you have a bigger discount on that, because obviously it depends on the next size of the round. So you have to be very careful there. And people jumping into secondaries without understanding that, then it gets a bit dangerous, because it's not one single class of shares like the public equities. So that's one thing to note about, to understand the liquidation liquidation preference. And then the other piece is that, everyone, when they say it's a secondary, they smell like a discount and they want to jump into it. But we've seen a lot in the recent years as well that, companies, when they go public, they don't actually go even hit the last valuation round. So that is something that we are also conscious about. We don't want to pay too much for secondaries, but it does lower our dollar average cost. So when we look at secondaries, we wouldn't look at it independently as a pure secondaries fund. We still look at it in the terms of like what would be opportunity for our existing portfolio right now that we're looking at. And so we know the dollar average cost of what we entered in before, and then how that might bring that down also for us. From a governance point of view, the thing about secondary investors or pure secondary funds, they don't have access to the same kind of information that we have because we entered in a primary round. We are very active investors, so we always take a board seat. We always make sure that we are involved in the corporate governance. And that's the insight that actually the secondary fund investors are very excited about, because they don't get that kind of insights from the company. The founder's not going to tell them that. The founders are not even incentivized to help them to carry out the secondaries because they don't get any fund injection unless they have, very painful shareholders that they want to help get out. So the information asymmetry, just because we already have such a stronghold in the primary position, we already sitting on the board, gives us that added advantage that we can also see, where the company's position is, strategically how they're thinking. So existing investors being part of the secondary process, usually it's easier to close a secondary round based on that. And more interestingly, we are actually looking at you right now that the CEO of the company is taking himself 20 million of secondaries. And that, for example, is a very strong vote of confidence, because if the CEO himself sees the opportunity to buy out early investors because he wants to get a larger stake in the game, that's a green flag for us.
So I'm going to switch gears now, because I think you are very familiar with the blockchain investment trends, and it will be really amiss of me, and I think Kelly was also stressed out on me. Please talk to Beatrice about blockchain investment trends, specifically on the tokenized assets, stablecoins, and even crypto treasuries. I think TGV for sure has been talk about the convergence of blockchain and AI. I think from your vantage point now, how is the blockchain landscape evolving today?
Yes, I think it's evolving a lot more to kind of looking at the financial part of it, especially the intersection between TradFi going to Web3 finance. We look a lot at like stable coins, tokenization of asset classes. And I don't think any of this was new. It's been there for a long time.
2017, people talk about it already.
Exactly. And then it was a lot of like the CBDC, central bank digital currency, issued more in a controlled way with the governance of the central banks, as opposed to kind of private players.
And I think China has announced that they're going to start doing it soon, right?
Yes, I think 10 days ago, Reuters said that China wanted to do a yuan-based stablecoin. And that's actually interesting because if you look at it, today a lot of the flows are coming in USD-dominated stablecoins. So that's where there's a lot of flows. That's where people are excited to buy into that. But at some point, every single country is going to be like, hang on, then my currency is not being used in a global scale. And for China, it's very interesting as well, because with the yuan, they actually get to have their currency kind of making its presence and use outside of China as well. And that's also an opportunity for them.
But then they use, based on what I was reading in the same Reuters press release, was that I think they currently only limit within China and Hong Kong. There is no offshore distribution of the stable coins, right?
Yes.
So it is still pretty hard to access as compared to, say, Tether. I think of it as a European money market fund, I think of Circle as a US treasury-backed stablecoin.
Yeah, so here's a thought. Like, it's very difficult to do capital controls, and that's why China never really went into cryptocurrency. So Hong Kong was always a test bed for them, and they kind of said, you can do whatever you want, Hong Kong, and then we learn a little bit from there, and then we kind of tweak to it. So I think that might be the angle of a play as well. And we have one of our portfolio companies, Animoca Brands, who announced a joint venture with Standard Chartered, British-based bank, and very reputable in South, I would say Asia and Hong Kong specifically, and they're doing a joint venture also with Hong Kong Telecom coming in. So Standard Chartered owns a majority of that for custody, but Animoca owns a very sizable proportion of that because they have the network with HKMA. And they're launching a Hong Kong dollar-backed stablecoin through the Hong Kong's new stablecoin legislation that came out on 1st of August. They were already involved with the sandbox before, but now they're doing the entire application, the same as the other applications, about like 40 that were rumored to apply. And HKMA is just kind of keeping it small. They want to have a closed group. They want to have single digit approved only. But that is actually an opportunity because if you have a Hong Kong dollar backed stablecoin, it's easier to get that swapped into a yuan, for example. So here's my thought that it could be that the Hong Kong dollar flows actually help with the swap into the yuan part. And that's the kind of gateway into the kind of yuan backed stablecoin. But again, I don't know what
But also contrasting this, quite similar to StraitsX in Singapore doing the stablecoin but as a private sector, whereas Singapore has decided not to do their own stablecoin from a government point of view. So do you foresee that this is going to become more and more common?
Well, I think there's going to be two schools. There's going to be the US, who basically, and like Singapore, for example, basically feels that, we should not do our own stablecoin. In fact, US passed a legislation to say that they would not do their own, CBDC. And then you have the different school where it's the kind of European Union portion that actually says that, I will look at it more from a central bank digital currency point of view because we want to keep it under the EU central bank. So I think there will always be existing two schools of thoughts. So far, of course, as usual, if it's coming from the private players, it is faster. It is going to kind of move quicker as opposed to maybe something that is started with from the government point of view. So I think that's kind of where we differentiate that there will always be these two schools. We don't know what will suffice, but I would say definitely the private one is going to grow much faster. It's going to develop much faster.
So if I were to think about broadening the conversation, think about now tokenization moving into, say, real estate, which is the holy grail. We talk about collectibles or NFTs. And then we think about now tokenized stocks, right? Which of the asset classes that you think would be very ripe for tokenization today then?
For me, I'm buying more on the kind of private stock tokenization. The reason why is because it is actually a process improvement as opposed to having to create a whole new demand and supply matching for it. Real estate has been there for a long time. I think we've seen like hotels who started St. Regis who tried to actually tokenize their real estate. But there's always been a problem with the demand and supply matching. Also, the regulations around it has not been built in a way that you can have multiple stakeholders within one property unit for a lot of cases and large jurisdiction as well, and then you take care about foreign investors, etc. But a private market stock has been a little bit different, where it's been already circulating that there's a secondaries, a platform like that. We actually have a portfolio company, Forge, that's very poised to do it, and I can say it now because they already publicly talked about it in their Q2 earnings call.
So here's a very interesting hack, right? So suppose if I'm a private investor and then I decided to create my own SPV, I went up to buy up, say, a lot of NVIDIA stock, and then I tokenize it, and then I put it to the markets, and then run a DeFi situation on top of it. Wouldn't it make the company who's actually, like say, a NVIDIA would be very worried because there's this secondary stock that's running around as a tokenized stock that's being traded, that will increase the volatility of stock. I think this is what the American banks are now trying to argue. The stock exchange are arguing and say, hey, you know what? This is good. This is a hack, right?
Yeah, because then you're a public company technically.
Yeah, technically you become a private. Yeah, there's no difference in becoming a public company. Maybe the question is, in the tokenized stocks, where will be the boundaries being drawn? Maybe that's the correct question.
Yeah, but you see some pushback from that as well. So recently, OpenAI and Anthropic actually publicly talked about clamping down on such SPVs because people are making fees on it. It's hard to control. And, they can't even report the UBOs. They can't even report which jurisdiction they are from.
It's effectively a shadow stock liquidity running around that we don't know how to control.
Exactly. So I feel that a lot of formalization of this and institutional investors to come in would come from regulated entities, players who push themselves to be regulated to go into that. And that's back to my point on the Forge piece. Why they're poised to do that is because they work a lot with the issuers, so the companies themselves. So if you loop them in, then it's fine because you know how to play out the right of first refusal, you know how to go according to their shareholders' agreement, and that's their bread and butter. That's what they've been doing. The only difference tokenization is access. So you basically can do it in 24/7 access of settlements if you can do that, and then you also get access to a different group of investors.
But they can also in the tokenization part, they can also issue the smart contracts of the whatever the listing rules and whatever within, right? So that also can be a kind of restriction to how the stock is being deployed on a DeFi situation.
I do agree, and I think that the smart contracts just have to be audited. So as long as there's a regulatory oversight or compliance in some way, like don't do something stupid that you know already that it should be something that is regulated. Of course, a lot of people takes the risk. So actually, I don't know if you know, but we actually started investing into Forge when it was before that. It was SharesPost and Fortune number 1, number 2 merging together. And SharesPost started investing in 2011. And they had a fine from the SEC in the beginning because they just don't know how to regulate it. And that's the same thing. There's going to be a lot of new instrument and a lot of new platform that, sure, you get a fine for it, but you learn that, the regulators are also learning along the way, like how you're going to regulate this process. But that's part of the pains of, having new technology, new financial instruments, new platforms to actually being regulated. And today it's an alternate trading system.
So I'm quite curious, right? Now that stablecoins is really, I think this is the killer app for crypto. I always feel that it is a killer app, but for some reason people don't want to talk about it. So it plays the foundation role in crypto DeFi. How would you access, say, the evolving stablecoin landscape? I think there is a convergence going on right now. There is Robinhood just launched, I think, with Arbitrum, and then you have Coinbase. Do you see that convergence between, say, fintech and crypto coming into one now?
Absolutely. One of the things that I really like, a little bit of excitement that I have into it, is to look at that intersection where AI and blockchain meets. So where that is coming from, and hear me out, is that we look a lot at like AI agents replacing a lot of menial tasks for us to do. And these AI agents would basically be able to operate maybe certain things, and then you come to a point where they're stuck because they have to deal with payments or settlements. And you cannot imagine an AI agent setting up a bank account with like OCBC or DBS, for example. Nobody is going to accept that. But what you can do is that stablecoin can come in as a use case to settle payments between agents, for example, and pay for that. And before that, if you're going to do like Bitcoin, there's a lot of volatility there. With stablecoin, it's pegged to a currency. So that is also the opportunity.
But you can do trade finance as well, right? You could think of like an ERP system owning what I call a penny stablecoin, so that I can do things like very small perishable payments using stable coins where it is not a credit card payment, but it's just a stable point, 0.02%. I mean, as a crypto investor, wiring 30K with stable coins is a totally different experience compared to remitting something through a bank into another country when you want to invest in a company.
Yeah, so I do see that there's a large overlap between servicing such rails and where stablecoin can fit in, where the kind of Web2 rails couldn't actually fit in. So I do agree with that.
Yeah, but I think that the question then is how the resistance is going to be, because there is still Visa, there's still MasterCard.
They will have their own. So we are actually very involved with Visa Crypto, and they've been very active in there. And then obviously you have the Coinbase, who are crypto native, and they have their base ecosystem. They're looking a lot at that as well.
And do you see now Coinbase is becoming more like an infrastructure company rather than Robinhood, where it's more like a super app for everybody?
Apologies.
No
yes. We do see that as well. And Coinbase is interesting because they have the resources to do that. And Robinhood has been coming into it, but they're coming from different angles, because Coinbase is starting from the crypto native environment where they have a lot of this community circulating around their ecosystem with Base, and they have the resources to go and look into that. Robinhood has the resources, but the community is a little bit different. They might not be the kind of crypto native, crypto savvy piece. Having healthy competition is always good. I don't think it's always something that, it's a single market player, and then, we have issues with antitrust, for example, etc. So I do like that healthy competition. My bet is that probably I would be more towards the Coinbase coming from the crypto native, just because they already have the existing community, they can grow faster.
I think Base app is pretty good as an application. I think now like wiring a Bitcoin is becomes so easy as before.
100%. I can totally see that, I just have to use stablecoins to pay it in the future. I don't even have to on-ramp or off-ramp it, because I just keep it in stablecoins.
Yeah, that's right. So I think now, as more jurisdictions now develop regulations for stablecoins, how do you foresee the impact, specifically, say, in Asia or even globally?
I would say it's definitely on different paces. A lot of people look at the US as like the big brother. So when they have set out their regulations, we've seen the Genius Act with the stable coin, and they have also set like regulation that they will not issue their own. That is going to be something that actually a lot of the rest of the world look to. And Korea is doing something. They want to look at the stable coin portion as well. We have Japan as well, on the Asia side. So definitely picking that up. Who's to tell what Singapore would do? Obviously, obviously, the key part of this is that, to my point earlier, is that every country would want to have their own currency being used. Like, why would I want to have US dollars being used in Singapore? Like, I want Singapore dollars to be used in Singapore. So there is a play that, to remain competitive, you should look at like your own country's currency and how that, whether is it you choose the private route or you choose the public route to do it with the central bank, how are you going to kind of compete and play into that? I think that's important for country leaders to think about.
I think that conversation we can continue at some point again, given I think we're still right at the beginning stage. I want to talk about, we're seeing on what they call on-chain treasuries, modeled after what Michael Saylor did with Strategy, or formerly MicroStrategy with Bitcoin, holding large positions of Bitcoin as a corporate reserve. I think now we recently started seeing firms like exploring Ethereum. Now they call Ethereum DATs, digital asset treasuries, okay? And even now Sol is going to be
exactly.
Solana. To me, those are the three blue chip the blue chip crypto assets, right?
Yes.
How are you seeing this trend evolve, and how do you view it as a viable playbook for, say, Web3 native and traditional companies? I think Ethereum seems to be, Tom Lee is now leading with the Ethereum DATs. So where do you think this is going?
I think we are kind of past that age where, you do a Bitcoin strategy and you think that you can stand out because you're no longer a first mover. It's been done it in many jurisdictions. If you think you can capitalize on FX, it's also been done. You have, Meta Planets in Japan, and in Europe, you have so many players. One of that actually we coincidentally backed because they actually developed their first blockchain Euro strategy. So, I should say stablecoin, treasury linked to Euro. No, not stablecoin, sorry, I'm mixing it up. It's the Bitcoin strategy linked to the Euro. So if you were to do like Michael Saylor's strategy, for example, and it's listed on the US exchange, you would have that FX risk if you're a European investor that I would get it in US dollars, but I'm in Euro. So they actually did that in the jurisdiction. So there was a play there at some point that, different countries can do that in their local currency where they build treasury and they're listed on the exchange, and then the local population in that jurisdiction don't have to incur that FX risk as well. So that was that play as well. And then we look at going from Bitcoin to Ethereum to Solana and all of that. I think at some point, if you were to pursue a treasury strategy like that, you should definitely look at how that impacts your existing business. It can't just be, purely like speculative and relying on that for investors to pour money in. It has to link back to, your main business. There an angle there. Maybe you're holding a basket of goods or a basket of currencies that actually support your portfolio within that, within your company. So that could be an interesting play, but there always has to be an innovative angle if you want to get money and investors in and not just be the next like Bitcoin strategy company. So, that's our position in terms of like when we're looking at companies and companies asking us, should they pursue that? I think they should look into it. They should develop new strategies, but it's not just as simple as like, I'm going to raise debt to actually buy Bitcoin.
But it's a winner-take-all market, right? Because if you look at, say, the stock value versus the asset value, currently, I think MicroStrategy or Strategy is now, I think, 1.6 against a better of the value. I don't know where the Ethereum one is going to be, but at some point, there are about 5-6 Ethereum DATs. I think probably the top 1-2 will survive. The other 3-6 can go sideways either way as well.
Yeah, because at some point people feel that it's more safer to go with someone who is a market leader already, can raise a lot of cash and continue to keep that treasury going, as opposed to a new player or a new entrant coming in, unless you're like 21 where you came in with a lot of firepower with SoftBank, for example.
Yeah, so you can still have the first two, but you can't have probably 3, 4, 5, and 6. They'll all be wiped out.
Exactly. So the in-between, you probably leave crumbs below. So I think that's kind of where you need to really make sure that if you're going to pursue such a strategy, there is a strategic interest for your portfolio. And then you're differentiating yourself because then you're actually benefiting your portfolio as well.
So there's this famous hack people say, right? Michael Saylor could easily, kill off an Ethereum treasury with just using it and buy it and then suddenly dump everything to the market to tank the Ethereum thing. Okay, I don't see that happening because it's a Bitcoin maxi, and I think everything else is not. He's not going to do that.
Yeah.
But let's say you look at, say, between ETH and Sol, what stops, let's say, a very, very big Ethereum whale for doing exactly the same thing to Solana just to tank their token price?
And I think, I don't know the exact answer, but I think that's what the foundations are actually very worried about. because they're very worried about, people being obsessed with manipulating that. And then all the work they put into building the application, building the layers of the infrastructure, it comes to a point where the entire system can just collapse because it's a systemic risk problem as well, right? I mean, the same with our currency. It's always a systemic risk. And the problem here is that there's no real regulator across different jurisdictions to regulate that. And it lies on the foundation, the responsibility, like how am I making sure that all the holders of Ethereum is not going to be just, pouring money into a Solana swap or something like that and then trying to tank it. It's very difficult to coordinate in the first place, but big owners or big holders of this can accumulate enough that they can tank it. So I think they need to set in place some certain form of governance to prevent that systemic risk. And that's on the owners of the foundation because no one else I see can regulate that from the Web2 world.
I think now from your viewpoint, what are the nuances, say, using Bitcoin, Ethereum, or Solana as treasury assets? I think there's volatility, there's custody, and even yield opportunities for Solana and Ethereum because of staking. How should founders think about the allocation mix within these three, I call blue chip coins?
So I wouldn't leave that to us to kind of advise the founders, but what we do actually impose amongst our portfolio companies, what we do advise is that we have always that 80-20 rule. And that is something that we've learned in 2015, 2016 when you have the whole ICO boom and crash.
That's right.
And maximum 20% of the company's treasury can be held in crypto, and they have to balance that every time the prices goes up and down. And we think that that's best practice because after all, it's a stable way to ensure that the company treasury still goes on. And I'm not talking about treasury strategy being your main business. You have an operational business. You have people, you have employees to pay out, and they ideally want it in cash or something that is stable that's not going to go all the way down. So that's kind of what we have imposed onto our portfolio companies. There was a lot of resistance because at some point, some of our portfolio companies will be very bullish on Bitcoin steadily rising. Like, why must we sell it down to keep the 20-80% rule? But it's all about discipline because if it goes up, sure, your shareholders will be happy. But what happens if it goes down? And as sitting on the governance of the board of director on this, that's what we are here to do. So there's a lot of conflict with our founders because sometimes they get too greedy, they get too nearsighted, and they forget that it could also go down very quickly. Going through that once, if we had a lesson learned that was pretty harsh, we would never allow it again. So that actually is one point that I would say we sometimes conflict with our founders just to maintain that. It's a discipline that we do impose.
Yeah, and also the market cycle changes quite a lot.
Yes.
So question for you, I think crypto goes through every 4-year cycle, and I always sell on the high, and then everything suddenly tanks, and then I go back into the earliest part of the market. I remember that this round I bought Solana at 9, so now I'm waiting. I'm reaching probably next year is probably the 4th year of that cycle, but there seems to be a consensus now that this is going to move all the way to 2025, 2026. So this would be the first time the 4-year cycle is broken. Where are you with the cycle?
I'm definitely optimistic that, because of the regulatory progression that has happened, that, maybe the 4-year cycle is going to be extended now. But even in the traditional market, we are also very apparent that there's always these cycles of, boom and crash, boom and crash. So it's not kind of being so obsessed with the cycle, but basically preparing for the long run. Like your companies must survive through the crash as well. When it happens, it doesn't really matter. It's just that you always have to be prepared for it. And I would say the good thing about the crypto space is that the entrepreneurs that you've backed, if you've backed them for a while, maybe since 2021, or I say pre-2021, they have been through that.
Battle tested.
Exactly. And if they still survive today, they have been through the down parts as well. And that's important as well because you don't know when it's going to happen. And it's difficult to run a company like that. Yes, it's true because you're more tested than the rest. But people who have gone through that, they're more resilient. And they have a very good rapport with the community. They have a community that supports them during the downtime as well. And that's the kind of differentiating point. So it's not so much important for us to speculate, whether it's going to be 4, 5, 6 years this time, or is it going to be less than, 4 years the next round again and repeat again. It's more that our companies are prepared to manage that when it happens.
Yeah, I actually find that crypto is always the best when it's a down period. I find that people are more encouraging, being nice to each other, and then essentially that's the time when I have the most trades. Now it's like in a boom cycle, I'm just sitting down there and watching everything go up, and I'm like, what am I going to do? And I have to wait again. So maybe just one question is, how do does TGV also think about treasury allocation within? I'm sure you hold a lot of crypto. How do you think about your balance between, say, a fiat currency, a stable coin, or even high conviction assets like the three blue chip coins that I talk about? How are you all yourself thinking about it? Not necessarily telling me the mix, but just like mental model.
Understand.
Yeah.
Yeah. So from our position right now, today, we have everything in cash. I just want to make sure that, I mentioned that because we're not that frontier to think that, we're going to manage our own investor monies with us in that kind of split. And that's prior to also us having the license. Now we have more room to think about that as well. But I want to bring up one interesting point, which is that when we did our last event, we actually had, Tim Draper talking on our event, and he was saying that the interesting part is that how long does it take for entire Bitcoin economy, like for someone to raise a Bitcoin fund, distribute in Bitcoin, and the money coming in obviously in Bitcoin, and distribute in Bitcoin, and then the investors pay tax in Bitcoin, like entirely Bitcoin ecosystem. And another point that was brought up that was interesting when he brought up the discussion is that people still see that as a longer term to come. But what is going to accelerate that process is when people realize that actually the US dollar is depreciating against the Bitcoin, if you look at it from that perspective.
Yes.
So it's better to technically hold your treasury in Bitcoin, even though it's not as stable, it's more volatile than the US dollar. So arguably a lot of people looked into that, especially when the US dollar kind of was a bit unstable or destabilized. And, we even thought like, should we hold some Swiss francs, for example, in terms of the currency mix? So I think that's a thought process that we've been going into as well.
I mean, traditionally, Bitcoin is correlated with, say, like a S&P 500. It behaves like a tech stock. I don't know whether after the terrorists now, Bitcoin has started to decouple a bit. And you're starting to see that it seems to be coming like a hedge towards inflation. If you start seeing inflation go up, what would be the interesting number is to see where does the Bitcoin price go, right?
Yeah, and I do agree with that inflationary pressures, but I think, and again, this is not advice or anything.
Yeah,
but
this is not financial advice and life advice to everybody. Sorry, Ivan DYOR.
if you systematically put money into Bitcoin with the SP 500, that for me is a good positioning than to, come in big at certain point in time and try to, outbeat the market. Of course, at some point, algorithmic trading is going to be able to manage that. But as like the normal investor who you're not, basically very focused on like the very micro movements, if you just steadily put it in, it could be a SP 500 for you. Easily.
No, I think it's still the S&P 500, except I'm just thinking of Bitcoin as a goal as part of the portfolio. If you think of in terms of the permanent portfolio strategy, Bitcoin is just part of gold. Yeah.
I mean, that's a very fair comparison and a parallel to make. Yes.
Yeah. So I have 3 more questions. We get to the closing, but the first one is, what's the one thing you know about TGV and venture capital that very few people do?
I would say like for TGV ourselves, like in the VC space, one thing that we know is that we would put a lot of skin in the game, a lot of cash in the funds that we manage, and that maybe a lot of VCs don't do. So the average in the US, for example, in VCs, like 1% of the fund is actually coming from the GPs who are managing the fund. And to a certain extent, some of them even just offsets it from the management fee, so they're not actually putting cash injection into it. And why I say that that's a advantage for TGV is that because we are completely aligned with LPs. Of course, our LPs like that. But at the same time, we make money when they do. So in terms of alignment there, we put in, all our money and all our time to grow this investment. Why are you not placing a bet on where you're putting in most of your time? So and I think that makes a difference in performance. So it's not really a secret sauce, but it's something that we really buy into. A lot of people talk about that, but we really buy into it and we really execute on it. So that's kind of where I think it differentiates us.
Nassim Taleb's skin in the game. Right. What's the one question that you wish more people would ask you about TGV or blockchain or AI, but they don't?
I would say like the intersection between blockchain and AI. I think a lot of people, they're so focused on either the financial part of the blockchain space or they're focused on the AI application side. But actually, I think the intersection is quite interesting.
Oh.
We actually started looking at the intersection in 2018, but there was like literally crap projects, didn't work out.
Oh, you didn't see virtuals?
not at that point. Exactly. We missed that for sure. And we do think that there's a lot of play going on that could be an opportunity there. So I think, people should look at more at that space. space. I talked about the stablecoin payment for AI agents, but there are also open source developers being paid in, at the end of the day, cryptocurrency is a very useful place for micropayments. So, open source developers being paid with micropayments based on how much the open source code is being used, for example, could be another space. So, I mean, there's a lot of that intersection that I think more and more people can look into. And I wish more people would go into that as well.
Yeah, I would probably say that it's very, very hard to tell. Sometimes everything is hindsight is 2020. My traditional closing question: what does great look like for True Global Ventures in the next chapter now that you're operating with a CMS license?
Well, I would say in the short term, we're still going to focus a lot on our existing portfolio. So for us, if we continue to deliver good returns for Fund 4, that's going to be, good for our investors. They're going to continue the journey and follow us along as well. And then with Fund 5, the secondaries opportunities coming with lower dollar average cost, that's important for us to execute on. So, accomplishing that from a investment period point of view, setting up the portfolio such that it's ready to be primed for harvesting, that would be good for us. So definitely focusing on our core. So we're not going to deviate away from venture investing. That's still our kind of bread and butter. And then in the medium to long term, what is great is that if we can explore the opportunities of the strategies that I talk about, like a pure crypto fund and not just in the venture investing and then investing in the crypto of the companies, we look at that potentially as something that we can go into. And then also in the medium to long term, like I mentioned, if we go into a public equity stock or fund of funds, that would be something that if we can materialize and raise funds on that, that would be a success for me, because that's what we got the CMS license to do as well, is that we could actually explore all these new areas that we previously couldn't. We were just taking a portion of that CMS. So that's the thesis.
Beatrice, many thanks for coming on the show and really appreciate this. I probably can, if my kids ever decided that they want to start very, very early to be in venture capital, I will tell them that you are the only counter example. They probably should talk to you first before they even think about trying, because their parents are not going to support it. So in closing, any recommendations that inspired you recently?
I wouldn't say that it was really a recommendation, but it's a conversation that I had with another venture capital fund manager. And it really kind of put things into perspective, like why we should stick to our thesis of 100 to 100 million. Because he was basically managing a fund that has gone from 100 to 100 million funds to 500 million funds to like $1 billion funds. And for his perspective is that he's working more as like a general partner deploying on his capital, but deep down, he realizes that if you have such a large fund, it's very difficult to deploy to get the same returns as a $100, $200 million fund, for example. So there is a lot of pressure. And from a management point of view, of course, it brings well because the management company earns a lot of cash from that. But that really got me thinking that, yes, we should stick to our roots. We should keep with this 100, 200 million fund. It's not about playing the management fee game. It's about playing the performance game. We want to make sure our fund has performed. And that really validated that thesis for me. So I would say that's something that recently was a thoughtful process. Yeah.
How can my audience find you and learn more about True Global Ventures now?
So definitely, we're on our website, True Global Ventures. You can definitely, once you Google that, you see a lot of news. We also run a lot of events. Our events also explore our kind of network and their friends as well online. And then we also have lunches and dinners that we hold. So you can definitely hear more about portfolio companies during events, thought leadership within the content that we've put together and the panelists online as well. So if you want to reach out to us on the website or my LinkedIn as well, happy to drop that also in the handle. And and get to know a little bit better. We could do something together as well.
Okay, and at some point we can talk. I will talk to you again. Maybe we can go a little bit deeper into AI the next time round. So you can definitely find us in any channel from YouTube to Spotify, and of course now on LinkedIn newsletter and our main site. So Beatrice, many thanks for coming on the show. I look forward to speak to you again.
Thank you. Thanks, Bernard.